The new administration built its entire platform on a promise to crush prices and aggressively demand lower interest rates to supercharge the economy. But in his first move as chair, Kevin Warsh did the opposite. He held rates steady and projected that 9 members of the Fed actually want to see rates increase before the year ends. The stock market immediately slumped. By refusing to offer the usual forward guidance or hint at future relief, Warsh signaled to investors that the era of easy-to-predict policy was over. To understand why a hand-picked chair would immediately defy his boss, you have to look at the optics. By taking a hard line now, Warsh establishes a public record of independence. He is essentially earning the right to lower rates later. If inflation eventually dips, he can claim he's following the data rather than a political order. This posture of independence is the first requirement for a much larger strategy, one that aims to keep the system liquid while the value of the currency in your bank account continues to move lower. Building out massive AI data centers and the underlying control grid requires long-term stability. For the technological-industrial complex, the old model of forever wars is becoming an expensive obstacle to growth. Cooling down Middle East conflicts, specifically by pursuing a deal with Iran, is a move to stabilize the flow of tankers and significantly lower the global price of oil. Since energy costs are a primary driver of official inflation metrics, a sustained drop in oil prices would provide the Fed with the statistical evidence it needs to claim that inflation is finally cooling off. This diagram illustrates the next gear. The Fed is moving toward a trimmed mean calculation for inflation. This method strips out volatile outliers, allowing the central bank to filter the data through a more controlled lens. By selecting which data points to include and which to ignore, the Fed ensures they can shape the economic narrative. If you control the measurement, you control the policy. If this combination of lower energy costs and revised math brings the official numbers down, it creates a green light for the second phase of the plan. Publicly, the Fed can continue to sell its treasury bonds to show it is tightening the money supply. But the private side of the system would work differently. By restoring an exemption to the supplemental leverage ratio, or SLR, the Fed can quietly deregulate how much commercial banks are allowed to hold. This exemption allows commercial banks to use massive leverage to immediately scoop up the treasury bonds that the Fed is selling. The banks step in to provide the liquidity that the Fed is officially withdrawing. While the bonds move from the Fed to the banks, the net effect on the economy is the same as if the Fed were printing money to buy them directly. It's quantitative easing, just laundered through the commercial banking system. This mechanism allows the system to remain flooded with cash without the Fed's own balance sheet showing the typical money-printing red flags that usually trigger public concern. But this strategy has a major vulnerability. The bond market doesn't seem to believe the story. This chart shows the yield curve flattening, with short-term interest rates spiking upward while long-term rates stay low, a sign that investors expect inflation to be stickier than the Fed claims. That spike is a direct threat to the Treasury. The U.S. government must refinance roughly $8 trillion in debt over the next year, and doing so at these high short-term rates creates massive interest expenses. Finding buyers for this debt is becoming more difficult. Over the last decade, foreign central banks, the traditional backbone of the Treasury market, have significantly backed away from buying U.S. bonds. Much of the slack is currently being picked up by highly leveraged offshore hedge funds. While they keep the market moving, they're far more sensitive to volatility than a central bank. If the stock market slides, these funds face margin calls and are often forced to sell their treasuries to raise cash. This could trigger a bond market sell-off that the Fed would be forced to address, likely by abandoning its posture of tightening. Regardless of the day-to-day fluctuations, systemic incentives align toward a continued expansion of the dollar supply. When the government needs to refinance trillions while keeping the banking system liquid, the path of least resistance has historically involved more currency entering the system. To see if this stealth easing is actually taking hold, there is a specific scorecard of 5 indicators to watch: a weaker dollar, higher stocks, lower 10-year treasury yields, higher gold prices, and higher crypto prices. Recently, these indicators flashed the opposite signals: stocks down, dollar up, showing that the market is currently resisting the Fed's master plan. While headlines focus on political drama, the true test of your purchasing power is being decided in the hidden plumbing of the financial system. Whether the Fed's strategy succeeds or fails, the outcome for the dollar is the same.